What if everything you have been told about war and the stock market is wrong? Because for over 100 years, during global conflict, markets did not collapse. They went up. This is legacy analysis, and today we are breaking down over 130 years of wartime market data to uncover one of the most misunderstood forces in investing. How conflict creates generational wealth cycles. Here is the data. In 7 out of 8 major United States military conflicts since 1914, the stock market delivered positive returns over the full duration of the war. During World War II, the Dow Jones rose 50% by the end of the conflict. During the Korean War, the S&P 500 returned 19% annually. During the Gulf War, the S&P gained 28.8%. During the Iraq War, the S&P rose 26.7% in the first 12 months alone. 1 year after the September 11 attacks, the market was up 7% on average. This is not theory. This is verified historical data. So why does this happen? Because markets are not moral systems. They are pricing machines. And during war, markets do not price destruction. They price predictability, government demand, and corporate earnings clarity. When governments begin issuing massive contracts to defense companies, those revenues become some of the most predictable in the entire economy. According to a 2022 National Bureau of Economic Research study covering 127 years of data, market volatility actually decreases during wartime. Defense spending converts uncertainty into guaranteed demand. Companies know exactly what they are producing, how much they are being paid, and how long those contracts will last. Now look at history. When World War I began, markets panicked. The New York Stock Exchange closed in July of 1914 and remained closed for over 4 months. When it reopened, the Dow had fallen 34%. Then something remarkable happened. In 1915, the Dow surged 88%, the highest single-year return in its history. By the end of the war, the market was up 43% from the start of the conflict. During World War II, when Germany invaded Poland, the Dow Jones rose nearly 10% the very next trading day. Not down. Up. After Pearl Harbor, one of the most shocking attacks in history, the market fell just 2.9% and recovered within a month. By the end of the war, the Dow had risen 50% and averaged roughly 17% annual returns during the conflict. This leads to a pattern that repeats across every major war. Phase 1, pre-war. Fear and uncertainty drive markets down between 5 and 15%. Historically, this has been the buying opportunity. Phase 2, the war begins. Clarity returns and markets recover quickly. Phase 3, active conflict. Defense and energy sectors lead while the broader market stabilizes. Phase 4, the war ends. Reconstruction begins and capital rotates again. The most important rule is simple. Selling at the outbreak of war and buying back later is consistently one of the most costly mistakes an investor can make. War reshapes economies. But more importantly, it reshapes capital flows. And for over a century, the data has remained consistent. Those who understand the cycle position early. This is legacy analysis.